The effects of the COVID-19 outbreak and ensuing MCO have led to a cumulative cut in interest rate to a record low of 1.75%. So let us see how does prolonged low interest rates affect us and other stakeholders. For a consumer, their accumulation of savings has been affected and they will have to think of ways to make up the shortfall. Many people have been struggling with the rising cost of living. A change in spending behavior can be expected, with more savings set aside for emergency use. Investment portfolio diversification is crucial to mitigate any underlying risks. Retirees could explore higher-yielding but slightly riskier investments such as high-quality money market funds, real estate investment trusts and other types of unit trusts. Or in a safe hand as for the Employees Provident Fund. For borrowers, interest rate cuts are definitely good news as the borrowing cost has become lower. When rates go down, borrowing becomes cheaper, making large purchases on credit more affordable, such as home mortgages, auto loans, and credit card expenses. At the same time, when the debt repayment be lower, the borrower's disposable income will be higher or the debt servicing period will be shortened. However, low interest rates tend to result in excessive borrowing and lowering of credit standards. The bank will take cautious approach in lending to avoid excessive borrowing. Before taking loan, borrowers are advised to do proper financial planning. Make sure you have the repayment capability for the next 6 to 12 months.
In terms of businesses, those that have substantial amounts of cash in bank may be thinking of ways to best increase their returns, such as spread to other investments that offer higher yields. It's also an opportune time for businesses to expand to take up new loans. However, with the pandemic raging and economic recession, chances are that there is only a handful of businesses considering expansion now. Besides, many businesses are turning more cautious in terms of committing to new borrowings during this economic downturn. Instead, they are seeking refinancing and restructuring of existing loans to manage their debt levels. Since interest rates had been brought down sharply since January, corporate loans growth was sustained at about 5% from April to June. It is more reflective of an improvement in bank credit flows and sustained economic recovery rather than excessive corporate borrowing.
In the efforts to repair the damage inflicted by COVID-19 and to revive the economy, the government has embarked on a behemoth fiscal stimulus of $295 billion. While the central bank has utilized its monetary policy tools, bond yields have been shifting downwards, and this means the government will be able to borrow and refinance at a lower cost. Government can seize the opportunity to restructure its liabilities to reduce the debt servicing cost and optimize the debt structure and composition. It will also give the government a more conducive environment to raise long-term debt to finance long-term infrastructure projects. The IMF also projects the overall fiscal deficits to widen more in advanced economies than in emerging markets and developing economies.
In conclusion, cheap borrowing tends to encourage risk-taking activities. Businesses and households could find themselves in too much debt or beyond their financial capability if not careful.